Good afternoon, everybody. Welcome to our Manufacturing Minute podcast. I'm Megan Metter with Brown Edwards. I'm an audit and assurance partner here, and I am currently the industry leader for manufacturing and distribution. So we're really excited about our Manufacturing Minute podcast that we're bringing to you guys. Our goal is to update you on the trends and hot topics shaping the world of manufacturing. And today, we are very excited to have Brian Wages from the Specialty Tax Group as our guest speaker. Welcome. Welcome, Brian.
Thanks, Megan. Happy to be here.
Yeah, absolutely. So, Brian, will you tell us a little bit about yourself and your firm?
Sure, yes. So, Specialty Tax Group was formed to come alongside of our CPA partners to help their clients save on their tax liability through tax credits, incentives, and deductions. And these types of programs that we help the client with are from doing regular business activities. So, these aren't credits that you buy and sell. They're just from doing activities that the company would be doing no matter what. So that's what we're here today to talk a little bit about those programs specifically for manufacturers.
Awesome. And today, I think we're specifically talking about also the state of Tennessee, right? And all the tax credits that are available to the wonderful companies that are in the state of Tennessee.
Yeah, and each state has their own tax credit programs, probably between 8 and 30 programs per state. So, while we're specifically talking about Tennessee, there are a few other states that have similar programs that I'll mention during the podcast.
Well, let's dive right in if that's okay with you, Brian. Yeah. So, what regular business activities can qualify me as a manufacturer for these Tennessee tax credits or as a warehouse or a distribution company as well?
Yeah. So, first of all, industry, manufacturing, warehousing, and distribution, those industries are called business enterprises or preferred industries in the state tax credit space. And the reason for that is every state is trying to get manufacturers to their area, incentivizing them to do certain things such as add employee, so growing the headcount. So we'll talk about that one. And then also investing in new equipment, industrial equipment. So those are the types of activities that Tennessee provides tax credits for those manufacturers.
So, well, do you want to walk us through some of those credits that are available?
Yeah, so the first one I want to talk about is the Tennessee Job Tax Credit.
Okay.
So if you're a qualified business enterprise as a manufacturer, there's a couple of activities that you have to do within that. So first of all, you have to create a minimum number of qualified jobs, and that depends on the county in which the business is located or will be located. Tennessee ranks their counties on a yearly basis, depending on how economically distressed they are. So factors like unemployment rates or average wages, those all play a part in these rankings. And the most economically distressed counties are called Tier 4 enhancement counties. And then there's also Tier 3, which are slightly less economically distressed. And then there's Tier 1 and 2 enhancement counties. So
Okay.
companies in Tier 4 counties have to add 10 new jobs. So that's the lowest threshold of job creation is 10 jobs. Tier 3 companies or companies within Tier 3 counties have to add 20 new jobs. And then companies within Tier 1 or 2 enhancement counties have to add 25 jobs. Now, in addition to that, that company must also make a capital investment of at least $500,000 within 3 years. So the idea is, this is generally an expansion of an existing facility or perhaps a relocation. Those types of activities that the company will be doing that will get them qualified for the Tennessee Job Tax Credit.
Okay, so you're saying that those need to be hand in hand. You have to create the jobs under the tier categories that you just explained, and then also, and I'm using the word and, not or,
Right.
do the capital expansion.
That's right.
Okay.
And the reason for that is they want companies purchasing, maybe purchasing facility or renovating, expanding a facility to add those jobs. And that's what makes it a qualified activity.
Okay, so if I'm a manufacturer and I'm in the state of Tennessee and I have, checked the box on which tier I'm under, I've done my capital spend, what do I need to do next to get that credit, researched or approved to make sure that I qualify?
Yes, so the approval process actually has to occur before the activity happens. So it's called a pre-approval, and it's through a business plan that the application has to be submitted, and it's submitted to the Tennessee Department of Economic and Community Development. So what they'll do is they'll review that application or proposal, and that proposal requires a few different things: the description of the business activity. So adding 25 jobs, that would be the description. Through an expansion, that would be the description. Where is the project located? So you provide the address and the county where that project would be located, the expected capital investment. So, we plan to spend $2 million building out our facility. You also have to include the wage information for the jobs. Obviously, they're trying to get higher paying jobs for their county and state. So that's why that information is required. And then the project timeline. When do you expect to start construction? When do you anticipate completing those hires? That type of information, that's all within the business plan that has to be submitted for that pre-approval. And then once the approval is granted from the Tennessee Department of Economic and Community Development, that's when, okay, you can start adding those jobs, start the project. And then after those jobs are created, that's when you will claim the credit based on, what that monthly average headcount is before the project starts compared to what it is after.
Okay, and those jobs, do they have to be a specific type of job, meaning production, oversight, or can it just be any type of job?
Any job, as long as it's a full-time B2 position, would
Okay,
qualify.
awesome. So, how much is this credit per job? What does that look like, and how does that impact the bottom line for me? How is it used?
So the credit per qualified job is $4,500, but
Wow.
they get to claim that credit for 5 years each year as long as they maintain that headcount. So it's not just a one-time credit. It is can claim it multiple years depending on if they maintain those jobs.
Okay. Now, talk to me about how the capital investment side comes into play as you try to qualify for the whole process.
So that capital investment has to be in the business plan. And then also separately, so that spend has to be there for the job tax credit, but there also is a separate program for industrial machinery. So there's a separate credit for that investment, the capital investment, if that is qualified industrial machinery. So that is the program's called the Tennessee Industrial Machinery Tax Credit. So there's actually two parts of capital investment. One, it's a part of the job credit, and then separately, it's its own program called the Tennessee Industrial Machinery Tax Credit. And that credit is generally it's 1% of that spend. The company would have to spend more than $100 million in order to get the next highest percentage up. We generally don't see that type of investment. There's only, a small portion of manufacturers around that have that type of spend.
Absolutely.
But it's 1%, pretty straightforward credit. Again, you have to submit that business plan to get that credit pre-approved before the spend occurs. But that credit can be used up to 50% of that franchise and excise tax liability. So it's another great program specific to Tennessee.
So I agree with your points there, Brian, because what I'm seeing right now with a lot of my clients is they're being potentially purchased by private equity or larger international companies. And the things about these credits is that they're available to use, right? And so it's getting the information out there that these credits are available. And we really need to let our new economic developers be aware that these incentives are available to the state of Tennessee.
Yeah, that's right. So these are statutory tax credits. So if the taxpayer or the company is doing the required activity, they are entitled to this credit as of right. They don't have to be chosen or selected as, recipient of it like it's a grant. These are tax credits that they are entitled to. Yes, they have to apply for them, but if they are meeting the letter of the law with these activities, so all those questions that I mentioned on the business plan, if they are answering it with the letter of the law in mind, they will be approved for either one of these credits. So the job creation or the industrial machinery tax credit, they are both really great programs that clients should be or companies should be taking advantage of if they are doing these activities. One thing to point out is communication. So since both of these programs require pre-approval, it's very important for the company to let you, the CPA, as the trusted tax advisor, let you know as soon as possible, even if they are thinking about an expansion or thinking about a relocation, letting the CPA know, hey, we may be doing this. That way we can make sure they qualify, have all their I's dotted, T's crossed so that they can have that business plan ready to submit so that they can get that pre-approval. Because if you do the activity prior to getting that pre-approval, you're not going to be able to claim the credit for that qualifying activity.
Yeah, that's good to know. I mean, advanced tax planning when you're doing these types of large investment projects are crucial in making sure that to your point, your trusted CPA can take care of you. And our job is to save our clients as much tax money as we can, right? So if the credit is there, we definitely want to try to apply. So what about, I know we focused today on the state of Tennessee. What about local states, other nearby states? What kind of similar programs are in place there?
Yeah, so a number of states have job creation credits or a program similar to that job creation credit in Tennessee. I know Ohio has one. A lot of those credits are a part of a discretionary incentive package. They have to be negotiated before a company moves to that state. However, a couple of states near Tennessee, down here in the Southeast, South Carolina and Georgia, have a little bit lower requirements. Georgia even allows the company to claim that job creation credit after the jobs have been added. So maybe a company uh, in Georgia added jobs organically. So maybe they didn't even have a new facility or expand or relocate. They just are growing rapidly. As long as they are in certain counties or certain zones, they can claim the credit with adding as few as 2 jobs. Similarly, South Carolina has job creation programs that start at 2 jobs added if they are a small business. So that's 99 employees or lower. They can get the job credit for just adding 2 employees from the monthly average from one year to the next. So all of these job creation programs are somewhat similar. They just differ on how to qualify as far as some qualify solely based on their industry. Some have to be in certain locations in addition to being in a certain industry. And then that threshold differs per state, and then the timing differs per state. So some allow after the fact, after creating the job, still qualifying, whereas others and most require having that pre-approval before the jobs are added. Now, the industrial machinery credit in Tennessee, there are also similar programs in Georgia and South Carolina as well. It's typically a percentage spend of the spend, so 1 to 5% on that manufacturing or industrial machinery, depending on where they're located. Could be a higher percentage in certain areas. Some states like Georgia give a higher percentage if it's pollution control equipment or recycling. So just think of, if you're a manufacturer, you plan on a big equipment spend, or you plan on adding a number of jobs, specifically if you plan on, expanding, purchasing a new facility, relocating. That's the type of activity that creates this tax savings, because these different states want their companies within them, the taxpayer, to grow, to be successful in their state, bring more jobs to their state, to help the economy in general, especially for their area.
No, I absolutely love it. And, being local, and I know we all are on the southeast side of the state, we want local manufacturers here. We want to grow. We want our economies to thrive. And so knowing this information is in advance as people prepare to move their manufacturing facilities, hopefully to our state of Tennessee or even Virginia, South Carolina, these are great things to know and be aware of as they think about their plans.
Yeah, hopefully the timing is great because, as you mentioned, tax planning. We're in the time of the year where companies start and CPAs start looking at that year end tax planning. So these are the types of things to be looking for that you can save on your tax liability in the future by doing a little planning and thinking ahead.
Absolutely. Well, Brian, thank you so much for being with us today and educating us a little bit more on all of the tax credits available to manufacturers in Tennessee.
Happy to help. Thanks so much for having me.